Good morning, everybody, and welcome to this week's webinar with FX Street. I'd like to thank everybody for joining today. Hello, everyone. Travis, Spencer, John, hello, everybody. Welcome to the webinar, and thank you, as I said, to FX Street for kindly hosting this for us. What we're going to talk about today is the one thing. Okay, so that one thing that I think most traders ignore, but will instantly improve your results, instantly improve your the setups that you're taking, and ultimately if it improves the setups you're taking, then it puts more money into your pockets, right? So before we move any further, let's first start off with the usual disclaimer, which is say the content of this video and the contents of this video are opinions only, and they're not investment advice. This video should be used purely for educational purposes, and all viewers are advised to seek their own counsel prior to investing or entering into any trade. Spread betting and any other type of financial trading carries a high level of risk to your capital with the possibility of losing considerably more than your initial investment. The contents of this video may not be suitable for all investors, and an individual should ensure that they're fully aware of the risks involved. If necessary, you should seek the advice of an independent financial advisor. I'm not authorized or regulated to give you investment advice. All right, so a little bit about me. For those of you that don't know me, sort of my credentials, if you like. I've been trading since 2005. In that time, I also did some consulting for a private investor fund. I've taught and continue to educate thousands of traders around the world. And most importantly, I'm a self-confessed market junkie, and I'm proud of it. If you want to follow me on any of the usual social media, Instagram, YouTube, Facebook, etc., just copy down some of those links there. It's at AlexOngUK for Instagram, it's /AlexOng for YouTube, and /AlexOngUK for Facebook. And basically I post charts and all types of things like that. So if you want trading analysis, then follow me over there. Okay, so successful trading is about looking at all of the relevant information and making an educated guess on the future direction of the market. Now, I think that this is an extremely important sentence to look at, because I think that far too many people assume that when they get involved in the markets, when they start to take trades, that there's some sort of certainty or guarantee as long as you find that perfect system. And I know that we don't guess, all right? I'm aware that we don't just guess. We don't put our fingers up in the air and hope for the best. But I think if we kind of took the approach that, we are making educated guesses, we're making decisions, but they're not certainties, then we'd all be a lot better as traders. Because I think as a new trader, when you get involved in a trade, right? When you start to take a trade and you think that it's a certainty, and then when the market goes against you and it costs you money, you kind of feel like you've done something wrong, or the market has done something to harm you, and that automatically puts your psychology into the wrong place. All right, and this isn't what this webinar is about, so don't worry about that. But I really do think it's something that everybody needs to get on board with. They need to understand that when we're trading, we're looking at all of the variables out there. We're looking at our charts. You're choosing whatever form of analysis it is that you like. And then based on that, you're making a decision on where you think the market's going to go. And you will either be right or you'll be wrong. It's really as simple as that. Ultimately, the best traders in the world are going to be right and they're going to be wrong at times. And the key is making sure that you protect your downside, you protect your account, so that when you make money, you're pushing your account up onto new highs, as opposed to trying to claw back stupid losses that you took making bad trading decisions. All right, and the bad trading decisions come from having a negative psychology, from thinking that you're meant to be right on every single trade. Most Forex traders, okay, and this is what this webinar is about. Most Forex traders, they tend to focus on their domain of expertise. All right, but only for the currency pair that they are trading. I want you all to just take a moment to think about this for a moment. So there's a few things in there, and it's all in the last part of that sentence. They focus on their domain of expertise, but only for the currency pair that they are trading. Okay? Now, the mistake, if in case you haven't got it so far, the mistake for me is that as currency traders, we tend to look at a currency pair as being just one instrument. Okay, we forget that we're looking at a pair, which means that there are two constituents, okay, in the trade. if we were taking a pound dollar trade, we're trading the pound and we're trading the dollar. We're trading the UK economy and we're trading the US economy, right? We're not just trading the pound dollar and the pound dollar as one pair or as one instrument in isolation, right? Trading without accepting this will, you can make money. If you have a good system, you're going to make money. But, all right, if you do really accept this concept, you're going to make your trading so much less stressful, okay? And you're going to improve your strike rates immensely, okay? Because we have to remember that at any one time, there are two countries and actions of those countries and central banks that can affect the currency's value, all right? And we also must remember that there's more than just one way to take a view on the direction of the currency that we want to trade. Now, what I mean by all of this, okay, and we're not going to go into, deep fundamentals or anything like that, but I need you to have an appreciation for what it is that we're trading here, because far too few traders actually take that step back and take that moment to think about what it is that we're doing. We just think that we're buying pound dollar because pound dollar is going up, or we're going to sell euro dollar because we think euro dollar is going to go down. But what we're actually saying is that if, say, for example, let's say we're selling dollar yen, okay, so we're selling the US dollar against the Japanese yen. We're not just selling dollar yen. What we're saying is that we think the US dollar is going to go down in value, and we think that the Japanese yen is going to get stronger. Do you see what I've done there? I've broken that down into two views. So as opposed to just trading the one currency pair, I'm looking at the two views here and saying, well, if I'm going to be selling dollar yen, what is it that I must believe about the economies of those two countries? I must believe that the US economy is going to get weaker. All right. And if it's going to get weaker, then maybe the central bank are going to do things to try and combat that, like cut interest rates, increase quantitative easing. And I think that the Japanese yen is going to get stronger. And again, that means I'm taking a view on the Japanese economy. Now, I know that there are going to be some people that look at fundamentals out there and they might say, well, Japanese yen won't just appreciate because the Japanese economy gets stronger. It's a safe haven and all of this. And that's true too. But my point is that when we're taking a view on the direction of a currency pair, we're taking a view on two different economies at the same time. Are you on the same page with me with this for the moment? Okay, so that's what I'm trying to get across to you here. We must remember that at any one time there are two countries and actions of those countries and central banks that are going to affect the currency's value. All right, and as I said, there's more than one way to take a view on a direction of a currency. So if you thought that the dollar yen was going to go down, all right, it might be that your view is that the dollar yen is going to go down because the US dollar is going to get weaker. But you may not necessarily believe that the Japanese yen, is going to get stronger. Think about that for a moment. So if the Japanese yen is not going to get stronger, but you want to sell dollar yen, maybe, just maybe there's another way to exploit this view. Maybe you look at it and you say, well, I think the dollar will get stronger, but I also think that maybe the euro, or I think the dollar will get weaker, but I think that maybe the euro is going to get stronger, hypothetically. Then wouldn't it be better to take a trade in the euro dollar as opposed to the dollar yen? You see what I've done there? And I'm not saying that you just pick this arbitrarily. There is an analysis approach to this by looking at the strong versus the weak and then putting them together. I'm just trying to give you examples right now. Does that make sense? Okay. So, as I said, strong versus the weak. One of the big advantages that we have as currency traders, okay, is that we use the fact that we have two driving forces in a trade to take higher probability setups. That's a massive advantage, and I think that too few traders don't actually look at this. They really don't. They just, as I said, they look at euro dollar as being an instrument that they're trading. They don't look at the fact that there's the euro and the dollar. Most traders, they're very one-dimensional. Okay, they missed one of their biggest weapons, one of their biggest assets as a currency trader. They completely ignore this. Now, before I show you any charts, just think for a moment. Think to yourself. Let's think about this logically. What if you were to find a currency pair that's very, very strong, it has good prospects for its future, and you pair it with one that is very, very weak, or at least not going to be as strong? If you start to logically engage this approach, do you see how automatically your strike rate should go up? You should start to make more money, make better trading decisions. Do you see this? Type a yes or a no into the chat box if you're still alive and you're still paying attention there. So let me ask you a question, all right? Let's take it a step back. What happens if you try and buy a pair where both of the constituents are projected to be strong? Let's go the opposite way round now. All right, so let's say you ignore all of this. What happens? Both of them are projected to be strong. What are you going to end up doing? You're going to end up getting involved in a choppy market, in a market that is moving sideways. Right? Exactly. Perhaps a lack of a trend. And we all know that, we don't need a strong trend, but we need movement to make money. And if both of the currency pairs have exactly the same outlook, then against each other, there's not going to be that much price movement. So we want to look at things that are extremely negative and trade them against things that are going to be extremely positive. Okay? That's how you make money. And it's something that we term as parallel and inverse analysis. It's something that I heard many, many, many years ago. Okay, I don't even know if that's necessarily the correct term, but it's something that's associated with this way of trading. And what that is it's the art of taking one strong currency and putting it against something that is much, much weaker. It's important to understand that just because I'm saying this, it doesn't mean that the immediate move is going to go your way. You're still going to have losses, right? This isn't a magic remedy, a magic solution, or a silver bullet or anything like that. You will still have losses. But it does mean that over the course of a particular trend, you're going to make more money than you lose. As long as you keep your stops wide enough, all right, and you keep your risk management in check, your strike rate is going to go way, 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 way up. Because if you think about this for a moment, right, let's say you've got a very strong currency and you've got a very weak currency and you pair them together. What happens if the dynamics of one of those currencies change? So let's say you've got a very strong currency and it gets a little bit of negative data. Does it automatically have a negative outlook to it? No, not with one particular economic release. These things take time. They happen over a period of time. So if something is very, very bullish, it doesn't automatically go bearish. If you're driving a car, you don't go from fifth gear into reverse without moving through neutral. So even if one of the currency pairs suddenly starts to behave differently, starts to have a different dynamic about it, it's rarely going to be an instant event. If you want to be successful, really, really want to be successful here, you really should start thinking from a global perspective and not from a siloed instrument perspective. This is what we're trying to show you here. So let's take a look at how you could implement something or how this plays out in real life. All right, this is a heat map I've got from fxstreet.com. Okay, fxstreet.com if you type into Google fxstreet space heat map, they will give you a link directly to the heat map page. And perhaps if fxstreet on here would be kind enough, you could even post a link in here for the people participating in this particular webinar. But basically, fxstreet.com have a heat map. Okay, now looking at this, let's try and look at something that is, particularly bearish against something that is particularly bullish. Well, if we look at the yen pairs, all right, you've got the euro yen there, the Aussie yen, and the dollar yen. We can see that they are all very negative. Now, remember that we're looking at the base currency and the quote currency. So the base currencies are negative, the quote currencies are strong. So we're seeing that the yen is getting stronger across the board. We can also see that the New Zealand dollar is quite weak. So the New Zealand dollar is losing a bit of ground. So what do you think the chart, if we look at those two pieces of information, right? We've got the yen and we've got the New Zealand dollar. What if we were to look at the New Zealand yen chart? What do you think we would see? Do you think we would see a big downtrend? Do you think we would see some nice opportunities to be selling the New Zealand yen? Just looking at this information here without even looking at the chart for a moment. You can see that the yen is getting stronger. I know it's red there, but the yen is the quote currency. So we can see that the yen is getting stronger across the board. Then if we go and take a look at the New Zealand dollar there, because remember, we don't want to put strong against strong, which is what would happen if we were to put it against the euro or the pound or so on and so forth. We want to put strong against weak. It depends in terms of the time frames that are most appropriate. It really depends, Mike, on what your outlook is. So this is a daily heat map here, and if we're looking at the daily heat map for the direction, then we're going to be looking for opportunities on the 1 hour or the 4 hour chart. Okay, if you're looking at a 1 hour heat map, then maybe you'd be looking for opportunities on the 5 minute chart. Okay, so it's really completely down to you. So this is what the heat map looks like. Let's take a look at that chart for just a moment. So that was the daily heat map, okay? And this is the New Zealand yen 1 hour chart. Look at that there. Look at the opportunities to sell. So the market breaks through structure there. That could have been a sell opportunity, but it doesn't have to be. We could wait until the market pulls back a little bit, like it does here, and then sells off again, like it does here. Or you could wait for another pullback, which you get here. Maybe take a trend line break and sell again. But the important thing to remember here is that we have a bias on the direction that we want to trade. We can look at this and think, you know what? We want to be short this. Why? Because we looked at the heat map and we saw that the Kiwi was taking a hit against everything. It wasn't up against anything. And the yen was getting strong against most things. So naturally, looking at the Kiwi yen was the trade that was going to yield the best results. Now, one of the drawbacks to this is that sometimes your trades are going to be fewer and further between because you're waiting for the right one, because you're not just chasing trades willy-nilly. Okay, so that's going to be something that's a drawback. But to counter that, what you could do is say take trades with a smaller position size, so maybe half of your position size, when you don't have all of this information going for you. So you're in the markets. It's like when you play poker. So you're in the markets, you're playing, you got to put your blinds in because you want to play the game. You want to sit at the table, right? But you don't have to take the big trades. You just wait. So you're just kind of, playing the odds, trying to make a little bit of money here and there, being active in the market, being engaged with the market. So then when you get the good opportunity, the one that makes complete sense, then you can really start to stack your chips and really put in the big money for the big win. And that's how, over the long run, you're going to make a good amount of money. Does that make sense to everybody? So let's just go back very quickly. This is the heat map. Look at the heat map. The yen is getting strong against more or less everything. But we need something that's weak. If we look at the New Zealand dollar, so the Kiwi, so if we look at the Euro New Zealand dollar, that's up, which means that the New Zealand dollar is getting weak. If we look at it against the Australian dollar, it's up too. Okay, if we looked at it against the pound, that would be up too. So that's telling us that the Kiwi is pretty much weak across the board. The yen is strong. Put them together, we get a chart like that. We're looking to sell, and look at the sell opportunities. They pay you. So do you see what we've done here? We haven't changed your approach for getting into the market. We're not changing your strategy here. We're giving you an extra analysis tool. We're giving you something else that you can use to make sure that you take the right trades at the right time. So the application, how do you go about trading this? Okay, very simply, you look to see the relative strength or weakness of a currency across the board. So what is getting stronger, okay, or what is getting weaker? Just find one to start with, just one. Once you find one that's particularly strong or particularly weak, you then look for a currency that has the opposite characteristics, and you pair them with one another. Okay, so you find one that's very, very strong, you find one that's very, very weak. You put them together. All right. Now, someone asked about time frame. So if you're looking for strength or weakness on a daily chart, which is what I recommend you do to start with, okay, then you're looking to take your trades from a 4 or a 1 hour chart. So you're always allowing the longer term dominant trends to help your trades. Does that make sense? So the question is, how do you identify strength, right? How do you do it? Well, there are a number of ways. You can use heat maps, like you have on fxstreet.com. You could use moving averages. So if charts are below the moving averages, then it's bearish. If they're above the moving average, then it's bullish. Or you could use plain old price action, or you could use a combination of all of those. It really doesn't matter. Okay, you're not looking to take your trades based on this. You're just looking to develop a bias based on this. You're looking to see where you're going to have the highest probability trades, where you put your money is going to make you the biggest amount of return for the least amount of stress. Okay? Any questions so far? Your system or strategy for entering the markets doesn't change. Remember that. All this is, you use this additional layer of analysis to back up your trading decisions. But your system, whether it be a price action system, whether it be an indicator-based system, whatever it is, it doesn't matter. Okay? You keep the same system. This just puts your strike rate up. So, you know, for example, if you were trading with 60% win rate, maybe you get 70% win rate with this. If you're trading at a 50% win rate, maybe you get 60, 70% win rate with this. This pushes your win rate up. But it's not a magical solution and it's not a silver bullet, okay? You have to remember this. This doesn't give you the 100% system. That 100% system doesn't exist out there. This is simply a way of stacking the odds in your favor to make sure that when you do take a trade, you are right way more than you are wrong. Does that make sense? Okay, let's take a look at a couple of charts. Okay, and see if we can spot a couple of these opportunities ourselves. I'll see how we go about. Oops. Save, cancel that. Let's look at identifying currencies that are strong versus currencies that are weak. And what we're going to do is let's just add a moving average there. So let's say we're going to use a moving average crossover system. So at the moment, the dollar CAD, you would say is looking particularly strong, although moving averages haven't completely crossed over. So therefore, it's kind of in no man's land. Plus, if we use a bit of price action here, we can see that we're coming up to a previous level of resistance, of support, which could act as resistance. So at the moment, we're going to reserve judgment on that. But let's start looking at the Aussie pairs. So the Aussie CAD, oh, hold on. Do long-short ratios precede the state of health of the currencies? What do you mean, sorry? Is it possible to, Carlos, is it possible to kind of clarify what you mean by that? Because I'm not too sure. Okay, so the Aussie against the Canadian dollar is a little bit neutral right now. I wouldn't say that it's long or short. It's just kind of moving sideways. The same goes for the Aussie franc. So looking at the Aussie franc again, it's kind of a bit sideways at the moment. It's not really long or short. The Aussie yen is definitely bullish, although it looks like it could be rolling over. So that's a little bit, we'll call that neutral. Aussie New Zealand is up though. Aussie New Zealand is definitely bullish. So what does that tell us so far? Right, that was a trade that we looked at taking earlier. We've already taken that. So what does that tell us? The Aussie against the CAD, the Aussie against the franc, the Aussie against the Japanese yen, all kind of in no man's land. You know, they're not long, they're not short. We hit the Aussie New Zealand, we can immediately see that this is long. Now, does this mean that the Australian dollar is particularly strong? Or does it perhaps more mean that the New Zealand dollar is a little bit weak? I would argue more that it's the New Zealand dollar is weak than the Aussie dollar is strong, because as we saw of the other charts there, the Aussie's kind of in the middle of no man's land. Looking at the Aussie against the dollar, well, this one is now rolling over, so that looks quite weak. There's another opportunity. Let me get rid of that there, that we got to take and play with. So that's rolling over there. So the Aussie dollar is weak. Now, again, does that mean that the Australian dollar is weak, or does it mean that the US dollar may be a little bit stronger? I would argue it's probably more to do with the US dollar than the New Zealand dollar. So what does that mean? Maybe just looking at that there, without looking at anything else, do you think that if we went across to the New Zealand dollar charts, wherever that puppy is, we would see that the New Zealand dollar is even weaker than this? One would assume so. And look at that. It's selling off much more. It's at a support point at the moment. Yes, it is. But if it gets below there, I would say that we're going to see the market go even lower. Maybe it pulls back initially, but I would say that if I were a betting man, which I am because I trade the markets, looking at a short position in the New Zealand dollar is really not a bad one at all. Now, it doesn't mean I put my whole position on here. Maybe I put a half a position on because the market's already gone quite a long way. And then after a bit of a pullback, I then put on the full position. So I build into my trade. I don't try and take everything all at once. That's stupid. No one wants to do that. But I put on a little bit of a position when the market breaks down here, when it breaks through here, and then eventually, when it really proves that it wants to go short, which I think that it does, because if we look at the Aussie New Zealand and the Aussie dollar, that tells us a story. The US dollar is relatively strong, New Zealand dollar is a little bit weak. But let's go and get some further information for our trade there. So let's look at the New Zealand CAD. What's going to be happening there? Now remember, the Canadian dollar's lost some ground itself here, so it wouldn't be surprising if this was completely the other way. Hold on. Eventually, when the chart updates. Whilst we're waiting for the chart to update, are there any questions? We've got about 5 minutes left of this webinar here, and I want to make sure that I answer any questions as well. Interesting. I'm trying to find a correlation that can be helpful, I suppose, since an imbalance in ratio can at times be helpful to make trading decisions. The Kiwi is presently weak, however, the CFTC ratio is approximately 70-30 in favor of shorts. That means that the price is trending on the 30% short side. Okay, so you're talking about looking at COT data. Now, the way I use that data, Carlos, is more as sort of like a contrarian data. So when it gets really, really overextended, that would indicate to me that the trend is coming to an end. I don't usually use it as sort of like confirming a trend or a trend continuation. Now, there's something wrong with my charts here. They're not updating for some reason. So whilst we're waiting for this, let me open up the floor for any other questions. This is very strange. Does that make sense, though, Carlos, what I'm saying there? Any other questions at all? Okay, now the chart is kind of with us. So we were looking at the other Kiwi pairs. Let's have a look now. Wow, these are taking very, very long time to update. Very strange. Okay, slight technical hitch here, everybody. Apologies for this. Oh, there we go. So a little bit better. So New Zealand franc is also looking weak, as you can see here. Now, so the technique is exactly what we've been talking about here. It's the idea of marrying up a strong currency versus a weak currency. That's exactly, it's exactly the thing. Most traders, in my experience anyway, they completely fail to look at this. Have you been here from the start? Al? Perhaps not. New Zealand dollar, look, also weak. If we look at pound New Zealand, we would want to see this going up in value. So you can see that there. Look at the pound and the New Zealand. So you can see here across the board that the highest, that how do you know whether a currency is strong or not? That's what we're looking at here, Al. I mentioned there's a bunch of different ways. So you can use a heat map for that. Or you can use moving averages, or you can use price action, or a combination of all of those, which is exactly what we're doing here as we're going through the charts. This is what I'm showing you. So we can see that the pound New Zealand is out above the highs here, so it makes sense to be buying pound New Zealand. Pound dollar. No, sorry, not pound dollar. So let's look at Euro New Zealand maybe. So we've already agreed that we think that the New Zealand dollar is weak. What we're doing now is we're proving it. So across the board, some of the best trades out there at the moment are going to be selling the New Zealand dollar. So it would make most sense to be looking for trades where you're selling the New Zealand dollar. And to do that, you then want to get to find the strong currency pairs. We've already seen that the yen is strong, so that would be a good trade, New Zealand yen. And then let's look at things like the euro. So is the euro up generally against things? Sideways against the Aussie a little bit. Sideways against the Canadian dollar. Selling off against the pound. Up against the yen. Okay, and then against the US dollar. Is up a little bit as well. So euro's kind of a mixed bag. The initial ones are kind of neutral, whereas the later, yen, pound, dollar are a little bit quite strong, but not really across the board. So perhaps there are better opportunities out there. Well, let's look at the pound. So the pound, strong against the Aussie, I would argue. It's looking strong against the Canadian dollar. It's looking strong against the Swiss franc. It's even looking strong against the yen. So, last one. And it looks like it's recovering against the pound dollar. So, looking at going long pound New Zealand probably is one of the best opportunities out there. So, you can then look for some sort of a price action setup, i.e. something like we have here. And look to take that opportunity. You could either be buying through the highs that we have here, or you could wait for consolidation at the highs. If you had been earlier, you could have taken a trade, a counter trend line break. But the point is that I always get a lot of traders saying, well, how do you know which are going to be the big moves before they happen? How do you know which pullbacks are the ones to get involved in? Well, this is exactly how. You do your due diligence into the currency pair. So you could have broken this breakout here on a close above this trend line. Yes, it goes sideways for a bit, but the bigger trend is with you, the longer term trend. The market is with you. because the pound is strong across the board, the New Zealand dollar is weak across the board. So buying the pound and selling the New Zealand dollar makes most sense, even if it goes against you a little bit. As long as you keep your stops wide enough apart, so maybe below this low here, you're going to make money. All right, this wasn't rocket science. And before you say, well, you know, it's all good with hindsight, remember that this is only at the end of last week. Okay, well, actually, it was yesterday. You know, those trends won't have changed in that amount of time. So you could have looked at this yesterday and taken this trade. Make sense? So in summary, the one thing that most traders fail to look at but will improve your results immediately is that of parallel and inverse analysis, of remembering that you're not just trading a currency pair, you are trading one currency versus the other, which means that if you go out there and you hunt out the strong currencies, the strong economies, and put them against the weak ones, then you're going to put yourself in a position where your trading setups you take are higher probability. If they're higher probability, it means you have a higher win rate. It means that you make more money. You don't have to change your trading strategy. Your trading strategy, it remains the same. Whether that be a price action based strategy, an indicator based strategy, it really doesn't matter. It's all the same. If you add this layer of analysis to your trading, you are going to make more money. You are going to be more effective in the markets. I guarantee you of that. Now, before we wrap up, we've got just 2 minutes left before we wrap up. Are there any questions at all? Or should we say goodbye now and say we look forward to seeing you on our next webinar in November? I find the anticipation of a potential trend reversal, and I emphasize potential by starting to look at 6 and 3 month charts and go from there. What's your take? Yeah, that's not a bad approach at all, Carlos. Looking at longer term charts and then looking for the reversals and jumping on from that perspective. Really not bad. But obviously, you're talking about reversals here. We're talking about just general trades. These don't have to be reversals. Thank you, Mike. I'm glad that you enjoyed it and that you thought it was thought-provoking. So, Al, you spot weak currencies by you're looking across the board at, you know, like if you look at the euro, you look at Euro Aussie, Euro CAD, Euro Pound, Euro Yen, Euro New Zealand, Euro Dollar, and see what it looks like across the board. If they look like they're selling off across the board, then you know that the euro generally is weak. Does that make sense? So you look at price action to be able to do this, or you could just simply look at FX Street's heat map, and that will then give you like a visual representation. Heat map. If you weren't here from the beginning, Al, perhaps you can watch the recording later because we've only got a minute or so left. And if you watch the recording that will be up on fxstreet.com very soon, in the beginning we talk about, well, actually in about the middle we talk about the heat map. Does that make sense? Yes, exactly, Carlos. So that's not too bad at all. Okay, everybody. Well, thank you so much for joining this webinar this week. I hope that you enjoyed it. I hope that you found some useful information. I promise you it's not something that you want to ignore. You definitely want to take this on board because it's going to help with your trading in the long run. I promise you of that. Okay? So thank you so much for joining FX Street. Thank you for having us today. And I look forward to seeing you all on next week's or next month's webinar. So take care now and have a fantastic week in the markets.